You mentioned a few moments ago, Dan, boomers and millennials. The question from our audience today is, what implications, if any, do you see from boomers moving into retirement and millennials moving into business leadership?
Well, it's a great question. One of the implications is this demand for yield, like we talked about before. And one of the underpinnings why our view is that interest rates won't go up that much is because the demand for yield product and paper, government paper, in different types of ways of investing in yield is going to remain, fairly strong from the boomer generation as they go into retirement and lose their salary, their income, their inherent income. They're going to be looking to really live off of some of their investment income, and we think that is one of the implications. Secondly, I think one of the potential areas of the economy that could be a big beneficiary is housing. A lot of people seem to have this view that the millennials are always going to rent. They're never going to own a house. They tend to all live in cities. And I can tell you, I have a pretty good lens or vantage on the country. I get to travel extensively for Morgan Stanley. Probably been in 30 or 40 different cities the last 3 or 4 years. And this view really varies depending on where you go in the country. And so one of the things I like to look at is objective data. And when you look at the data shows broadly that the millennials really aren't dissimilar or unlike any other generation beforehand. What do I mean by that? Well, the millennials do have some quirky things that they're known for, and look, they've got products that they're more familiar with than others. They tend to be on their phones a lot. They tend to be very versed in social media, etc. But they happen to have pretty poor timing in terms of their graduation vintage. A lot of them lapsed the 08-09 vintage year and had trouble getting jobs and seeing higher salaries, etc. And they were kind of saddled with a lot of debt, student loan debt as well. But if you look at some of the data the last couple of years, what's going on underneath the surface is the millennials are really coming back. They're starting to see higher job growth, higher wages. They're starting to pay down their student loans more aggressively. And as such, they're starting to buy houses. And if you look at the housing formation data, the strongest cohort of new housing starts is 25 to 35 years old. That is the millennial generation. So the whole idea, the perception that the millennials are never going to own a house and they're psychologically or structurally different from any other generation isn't the case. It's not a secular difference. It was the cyclical timing in terms of the year they graduated and how badly it was in terms of gaining some income, in terms of their slow start to become more bigger owners of houses. Now, why is that important? Because housing is a big part of the economy. And the fact of the matter is we expect housing prices to continue to gradually appreciate, maybe 5-6% a year. And that's very good for homeowners. We also think that when you look at housing prices broadly, they're not really out of whack on the average math. Now, certain cities, certain areas, I was in San Francisco last week for business, that's an area of the market where it's pretty frothy. New York City, where I work and live, that's another area that's frothy. But look, those are two massive bubbles, the massive niches in terms of the economy. If you look at the broader picture, 45 out of the biggest 70 cities in the country, in the U.S., have not recovered their pre-07 housing price peaks. 45 out of 70. So the question was about, the implications of millennials and boomers, and we think more demand for yield, which keeps interest rates lower, not bad for stock valuations. And as the millennials start to get higher paid jobs, more demand for housing.